Hello, Environmental Policy 2 students. It's Dr. Conway back for week 3 on how businesses assess environmental risk. We're going to get into this subject matter in greater detail as we go through this particular course, Environmental Policy 2, but I wanted to provide you with a basic overview of the issues for business as we get into this course in week 3. Now, of course, risk management or risk assessment in business is a bit more of a straightforward project, if you will, because businesses have a rather simpler motive than governments have for managing environmental risk. Businesses, of course, manage environmental risk to minimize their exposure to non-compliance with regulation, but also to minimize their exposure to the market and to what their consumers or what their clients might look for, or their stockholders, for example, might look for in proper business conduct. But there's now no question that businesses of any significant size, in particular, must take the environmental aspects of their business fully into account, because there's just simply too much regulation and too much risk to the market, exposure to the market if major environmental problems happen. And we can see that in many aspects of private business and the environment. Of course, the most obvious being in Canada right now, the oil sector and the issue of pipelines. But when we look at business, we need to, and the environmental risks that businesses are exposed to, we must remember that key message from the first Environmental Policy 1 course, where we must consider risk in the context of the entire life cycle of a business's product or service. And so don't forget the issue of life cycle management, life cycle assessment as a basis of looking at all aspects of the environment for business. And that includes risk management. And these days, financing a business becomes a critically important issue with respect to the environment, because investors, stockholders are becoming much more sensitive to environmental risk in assessing their investments and their investment needs. And this is for companies of all sizes. Banks now look at investments into even very small businesses with respect to environmental risk, because no investor wants to buy into a company or invest in a company that is exposed to substantial environmental risk unless there's a lot of other factors that can be put into play to mitigate that risk. And this became especially clear in 1998 when Dow Jones began submitting sustainability index reports on major companies. Okay, and these indexes basically rate companies against rate the performance of companies against environmental risk criteria. And that is now more and more the case. And we see it in environmental assessments of buying property for a small business, in environmental assessments of all kinds of major infrastructural investments of a company, and so on and so forth. So now the environment needs to be fully integrated into the business practices of any business of any size, really, but especially very large businesses. And so large businesses put in place really systematic processes for identifying and evaluating risk events or risks of any kind. And that's why you see today many large corporations will have their environmental divisions or their environmental units, the sole purpose of which is to make sure that the company stays in compliance with environmental regulations, but also to monitor the company for risk across its entire life cycle. And the reason for that is what I was mentioning a little bit earlier. I mean, it impacts access to capital for the business if something goes wrong in the area of the environment. Financial performance statements and increased shareholder value is put at risk if there are major environmental problems that arise. For example, like an oil leak or any kind of other, or a gas leak or a chemical spill or anything like that. That can all cost literally billions of dollars to clean up. And obviously shareholders, stockholders of the company are going to be quite concerned about those types of outcomes. But also the company has to be very concerned about maintaining its license to operate. I mean, if a company is found to be in non-compliance with important environmental regulations, I mean, they can literally have their license to operate suspended. The government can do that if there's a major egregious environmental risk that has come to fruition and was not properly monitored and preventive measures were not put in place. So license to operate risks are there, and it can be quite significant, quite serious if all of a sudden the government comes in and says, well, this rail line or this pipeline can no longer operate for environmental reasons and public health safety reasons. But also environmental risks, if they're well managed in advance, if there's preventative practices rather than mitigative practices in the company, there are major operating cost implications. It's always much cheaper to prevent than to mitigate. And that goes for governments, people, and corporations, okay? And of course, then we get into issues of the corporate brand. You cannot, in this market today, you cannot surrender a major reputational issue like a proper or accountable environmental company in the marketplace, because there'll be one of your competitors that will be using the environment to advance their market brand. And if you do not do the same, the risks to your corporate profitability will gradually increase to the point where some companies in the market will be seen as dirty while other companies in the market will be seen as trying their best to improve the environment. All we have to do is look at the recent Volkswagen controversy over falsifying emissions from diesel engines to understand the significance of the issue of corporate brand. It will take Volkswagen decades to recover from that, to totally recover from that form of environmental corruption. And of course, related to that corporate brand is the broader issue of customer loyalty. I personally know people who own Volkswagens, own 2 or 3 of them in a row, who after the Volkswagen controversy on emission falsification basically moved away from the brand. The new cars they bought, they won't ever buy another Volkswagen. And so that might appear to be a small fraction of the population, but if it's 20 or 30% of loss of customer loyalty, that can add up to many, many hundreds of millions of dollars over time. And then there's the issue of productivity and quality. Companies that advance environmental objectives clearly and stick to them find it a lot easier, and the evidence indicates that, find it a lot easier to attract and retain top quality talent, especially younger people who have been raised valuing the environment. Without that environmental reputation, it makes it much more difficult to attract the best people and retain the best people. And obviously, in any business environment, one of the most difficult issues of any business is to attract and retain the best people. And if your reputation is such that you can't do that anymore, or you can't do that as effectively as your competitor because you're seen to be a dirty business as opposed to an environmentally responsible business, that becomes a giant issue, an anchor around your neck. And so attracting and retaining good employees is a really critical issue for business, and the environment has been proven to have a significant impact on that. So if at some future date you get employed by a business and you're in their environment unit, one of the first things you're going to have to do is understand the specific operations of that business throughout its life cycle and be able to analyze environmental risk at each stage of the business's life cycle. So from Environmental Policy 1, we spent some considerable amount of time talking about life cycle. But this is where the rubber hits the road. You're hired by a business, and your first thing you should be looking at is making sure you have a really good understanding of the various stages of the life cycle of the product or service, and then analyzing each stage of the life cycle to determine where the greatest risk is and put in plans to manage that risk profile. But in order to do that, of course, businesses need to be able to find some way to categorize those risks, because there may be several through the life cycle of a product or service. But categorizing and ranking risks is a key issue in any business. You might have, let's say, 75 significant risks, but 50 of those might be fairly well managed and don't pose a huge downstream impact factor once you begin to analyze them. But maybe 1/3 of them do, and they provide substantial risk. So, like any government, a business is constrained by what it can do by time and resources. So, prioritizing risks for a business is equally important as prioritizing risks by a government. Okay, so a business has to know where its most serious exposure risk is and put in place ways to manage that and put in investments to manage that, whereas other risks may be able to be managed by simply sharpening up certain procedures or processes without having to make substantial investments. So understanding the really detail of a life cycle of a product or service, and then beginning to categorize and assess the most significant risks to the viability or to the business objectives of that company, of which one will obviously be the profit motive, but others will be things like corporate brand and those things I just went through. Those are two very important skills that any environmental officer within a large corporation will quickly realize are the most important aspects of their work. And so, but there also has to be recognition of another key criteria for an environmental officer. One is, there's a tendency, of course, there would be in ranking your risks to focus on those risks that are most severe and most immediate. But one of the things you cannot forget as an environmental policy officer, an environmental officer within a corporation, is those factors that generate a cumulative risk. Those factors that, for example, gradual contamination of the facility site over time, if not controlled today, could become a major headache for the company down the road. So whereas an oil spill is an acute and immediate risk, a gradual contamination of the soil around a facility over time through micro spills and so on can be a chronic but quite serious risk for down the road. So you need to look at those types of distinctions as well. For example, there might be some chronic risks that cumulatively are probably fairly well maintained and can be cleaned up relatively easily over time and so on, and don't accumulate to anything significant. But other risks that might seem minor today but are cumulative may end up being quite severe risks for the company down the road. And so these kinds of distinctions also have to be made, because for the non-expert that you're preaching to within a company, of course, their immediate bias will be to go to those immediate acute mega risks like an oil spill or a train derailment or a gas leak or a chemical spill or something like that. But it's your job as an environmental expert to yes, assure them that things have to be done immediately to deal with those particularly acute risks. But the company cannot forget its chronic risks. And those chronic risks need to be addressed through putting in place systematic procedures to minimize the events that are causing those risks to occur. Now, you'll also notice when you get into the industry, if you do work in a private company, that companies tend to become more expert over time. Initially, companies, particularly small and medium-sized companies, will start off with relatively rudimentary qualitative type assessments of their risk. But large corporations that have been at this business now for probably 30 years and maintaining more systematic processes for maintaining and are managing environmental risk will now have in place quite systematic and quite sophisticated techniques of data gathering and monitoring and inventorying and recording small spills and how often they're happening, from what part of the plant and what's causing them. And they'll have quite sophisticated databases now of their risk profile with respect to the environment. So one of the things that you'll notice if you do get a job with a larger company like a Dow Chemical or something like that, you will see that their systems have become quite sophisticated. Whereas in the smaller and medium-sized companies, they're maybe just starting out or that never had the resources to put into environmental risk management, but now do, you would be building those systems over time. And I think what you'll find is that that can be quite interesting work and quite challenging work. But you know, a lot of the bigger corporations will already be there. And if you work in there, one of the things you'll be doing is coming up to speed on their quite sophisticated systems and statistics for managing risk. Now, later in this course, we're going to be dealing with things like environmental monitoring and how it differs between government and corporations and so on and so forth. But when we go through the course, we'll be learning more and more about how businesses are managing their environmental risk and are managing how they improve over time with their environmental performance. On that, I'll let you go, and we'll be back to you again for week 4. Take care. Bye-bye now.